My name is Greg Simmons. Thank you, Kathy, for introducing us. Dan and I work for Action Housing, as Kathy mentioned. But prior to that, we were a compliance and loss mitigation team at National City Mortgage, where we were responsible for pursuing recourse on mortgage brokers, mortgage lenders who were doing things they weren't supposed to be doing. And Dan was our compliance manager and was largely responsible for our truth in lending compliance and how to actually manipulate that and make that work for us. So our background is more mortgage lending, and that's what we're here to talk to you about. It's nice to see the room so full. There was a time about 5 or 6 years ago when you put on a presentation like this and no one would show up because apparently there was nothing going on that was worth talking about then. So this is nice to see. So I appreciate everybody coming out. This is just what we're going to be talking about. We're just going to kind of cover some basic underwriting stuff, loan types, documents, how the primary and secondary markets are working, and then we're going to switch to Dan, and Dan's going to talk about housing counseling, and in particular, the conciliation process that we set up through the court system in Allegheny County to kind of help put some weight on getting some of these loans resolved for people so that they don't lose their homes. So I'm going to start by talking about underwriting a little bit. Anybody who's ever looked at a Fannie Mae book, guideline book, it's 1,000 pages long, and you look at it and you probably think, holy cow, there's an awful lot of stuff here that we'd have to know about mortgages in order to do this successfully, and really that's not the case. There are really only 4 basic concepts in mortgage lending that apply to virtually every mortgage, and they are these 4: credit, capacity, collateral, and capital. And I'm going to kind of go through them to kind of give you an idea of what we're talking about. If you've got some basic understanding of these 4 items, you could pretty much look at any mortgage and tell whether it's been written properly or whether there was any kind of funny business going on with it with pretty basic glance of it. It's fairly straightforward. Credit, everybody knows what credit is. Credit is the borrower's past repayment performance used to determine whether or not they were a likely risk for credit in the future. So if someone has a history of not making their credit payments, their credit card bills, whatever, are they likely to repay in the future? Probably less so than they would be if they had always made their payments. It's generally expressed as a FICO score, Fair Isaac score, which is, excuse us.
Trying to get you some water.
Okay. Hang on a second for the water. Fair Isaac score, which is a number anywhere between, I guess, generally 400 and 850, that expresses the person's credit worthiness. The higher the number, the better the credit score. I'm sure you guys are all familiar with a FICO score. The next one is capacity, and this one is a little bit more tricky. Capacity for mortgage lending purposes is generally expressed in 2 forms. In its simplest form, it's how much mortgage can the homeowner actually afford to repay. And it's expressed as a front-end front-end ratio and a back-end ratio. And what they're looking for here is they're looking for the amount of the first mortgage that the homeowner can repay and the total amount of debt that the borrower can handle. So a front-end ratio is going to be principal, interest, taxes, and insurance. It's the housing ratio. It's very simply how much is the housing payment that the borrower can afford against their income. And then the back-end ratio, the debt-to-income ratio, is how much in total debt can the borrower afford to repay. So what you wind up with in the debt-to-income ratio is that they've taken credit cards, less housing, and that's the total. So if you have a front-end ratio of say 30% and a back-end ratio of 40%, and the borrower makes $1,000 a month, they can afford a $300 mortgage payment and $400 in total debt service. As that total debt service increases, that housing decreases. So if you now have a borrower who has $200 in debt service, they can only afford a $200 housing payment. So the 2 things are inverse. Am I making sense with that? Any questions about that at all? Okay. The third one is collateral, which is the property, the home in this case, that's being used to secure the loan. And this is probably the place where you see the most funny business in the mortgage lending business. An appraisal is basically a view of a house that has features and condition of the property And then it looks at other houses of similar features and condition, generally within a half a mile. And the appraisal is supposed to give you a general idea of the value of houses in the neighborhood with those same features and condition. What winds up happening is you wind up seeing a lot of lenders that take these things and you've seen a lot of appraisers where they've taken these things and started using comps from further away or comps that weren't reasonable. So when you're looking at an appraisal, some of the things that you really want to consider are the comparables reasonable? So if you've got a 3-bedroom ranch with 1.5 bathrooms and your comparables on your appraisal are a 4-bedroom colonial with 4 baths and a 3-car garage, probably that's not a good comparable, and that would be an indication that there's something fishy with that. Adjustments. An adjustment on an appraisal is there are assigned values for certain features. So for example, if one house has a garage and one house doesn't, they might add $5,000 or $10,000 for the garage to one and take it off of the other and then make an adjustment. So if you've got something where you're seeing an adjustment that seems outsized, so for example, a house might have a garage and they're giving you a $50,000 adjustment for a garage, that would be unreasonable. It would be the kind of thing that would be a red flag that somebody might have been trying to manipulate the appraisal. Condition issues or other adverse issues. This would be the kind of thing where I can tell you firsthand, we've seen appraisals, for example, where there would be a house and you look at the house and say, okay, it's a house. And if you turn the camera the other way, there's a house and there's a factory standing next to it, those kinds of things that the appraiser is supposed to know in making an assessment of the property, but don't always. And municipal boundaries. Now in Pittsburgh, this is a huge issue because we have so many municipalities within Allegheny County, and they are very much a jigsaw puzzle, and they kind of fit together. And you literally can have two sides of the street with a $50,000 house and a $200,000 house, depending on being in a different school district. And that's one of the things that appraisers who were doing bad lending were really making an issue out of using those boundaries to get higher comparable values for their homes to pump appraisals. And they should have been using things within the same municipality. So my house might be in the city of Pittsburgh and using all suburban properties with suburban school districts when they should have been using all city properties. Any questions about that at all? Am I going too fast? Probably. And the last one is capital. And capital is quite simply how much money is the borrower putting into the transaction themselves. It's money. How much money is the borrower investing in his own home, the down payment. It used to be that they wanted to see 20% down payment on a property, and the idea was that by putting that down payment down, the borrower was making an investment in the property and would probably want to recoup that money, and they would be a better credit risk. It's an indication of stability, it's an indication of commitment. As you all probably know by now, one of the things that happened over the last 10, 15 years or so was that they got away from having anybody make a down payment on their home. So getting into a house was incredibly easy. There were no capital requirements, there were no credit requirements, and there were no, well, the collateral piece was corrupted beyond repair. So you wound up with some real shady lending going on. So of course all of these things tie together. Of these 4 C's of underwriting, credit is generally the one that you're going to have the least problems with, because if you're dealing with your actual borrower, the credit score is what the credit score is. It's very hard to manipulate that unless someone is using a straw buyer or borrowing somebody's credit, but you generally don't see that all that often. Capacity, again, is the income versus the debt. The place where you're going to see things out of whack with this are either fraud or loopholes in documentation that are being used to commit fraud without actually calling it such. Could be anything as simple as somebody faking a W-2 and typing up a W-2. It can be something like using a stated income loan for a borrower that absolutely does not qualify for the loan in order to give them more money than they can afford. How many people in here actually work with these kinds of clients that have seen this stuff? So I'm preaching to the choir a little bit, maybe? Okay. The collateral piece, again, I've seen appraisals The appraisal piece, we look at these houses in, say, California, for example, where the appraisals are so out of whack and everybody's underwater by 50%. There's an open question as to whether the housing market was driving the lending or whether the lending was driving the housing market. And there's an argument to be made that had the lending standards not gone away and had the collateral requirements and the view of the properties not been as loose as it was, that the lending wouldn't have been as free, and therefore the housing market would not have gotten as heated as it did. So that's always a big issue. And capital, of course, it's always a good thing for people to have capital. I will say one thing that we have seen in dealing with predatory lending was we have actually seen lenders who will take money and deposit it into a borrower's account in order to show capital on the loan application with a copy of the bank statement and then take it back. And they've used that for fraudulent down payments and down payments that didn't really exist, so they could show it on a settlement statement. Any questions about the 4 C's of underwriting before I go on to secondary mortgage?
Sure. Capacity aspect. I've seen on mortgage applications a markup of income, benefit income, because of non-payment of taxes on the benefit income. Is that a relatively routine practice?
Give me a little more detail on it.
I had a father and son who were receiving Social Security and SSI payments.
Okay.
On their mortgage application, the preparer of the application goosed the figure.
Grossed it up.
Yeah.
Yeah, that actually, I don't believe they're still doing that, but yeah, that's called grossing up income, and they use it specifically with Social Security. And the idea was that because Social Security wasn't being taxed the same way income was, that you could use $1,000 of Social Security as the equivalent of $1,250 of regular taxable income. So they would gross up the Social Security income. Personally, I always thought that was kind of a stupid idea, but it was pretty common in the mortgage business, yeah. And I've had that argument with many lenders. Yeah.
We have a HAMP program that actually allows lenders to do that.
Well, okay, then I guess they are still doing it. Yeah, it's not a great practice. But yeah, it is what it is, and that one came out of Fannie Mae too. So that's not. Yeah, you could argue that one all day long. Any other questions about mortgage underwriting?
It used to be that the buyer's capital needed to be their own rather than a gift from their parents. Is that still an issue?
The way it's handled typically is that if your parents give you a gift to purchase a home, that would have to be documented. The parents would typically have to provide a letter, or whoever it is that gives you the money would have to provide a letter that they have provided it as a gift. And yeah, that is a consideration that an underwriter would take in. Is it their own money or was it gift money? Generally speaking, with the gift money, money is money. So the underwriters weren't looking at it, was it theirs or wasn't their parents. They're looking at it as it's just money, it's down payment. So I've never seen anybody get rejected for a loan because they were using somebody else's money instead of their own. So, any other questions about underwriting? No? Okay. Loan types, just to go through these real quickly. A fixed conventional full amortization loan is like a conventional 30-year mortgage. It's a fixed rate loan. It's going to be paid off at the end of the 30 years. The payments and the principal come down every month, and it's generally what's considered to be a normal loan. An adjustable rate loan is just that. The rates can adjust periodically based on an index and margin published in the note. One of the problems we saw a lot of in Pittsburgh was people who had ARMs and didn't realize they had ARMs, as you may be seeing elsewhere in the country now. A balloon payment, a balloon note is a loan that pays for a specified period of time and then comes entirely due. So you may have a mortgage for, say, $50,000 with a 15-year balloon am, and at the end of 15 years, that $50,000, that homeowner may still owe $40,000 on it. And I have absolutely seen homeowners that had no idea they had these things, and you point it out to them and explain it to them, and they just didn't know because nobody ever explained it to them. An interest-only loan is exactly that. It's a loan that just pays the interest and never reduces the principal balance. And the idea being that you'll just refinance it within 3 years anyway and get rid of it. An option ARM An option arm was kind of a tricky product. You may have heard about, this is the one with the negative amortization, where the balance on the loan can actually increase. And what they do with these is it's an adjustable rate loan, but the option arm has 4 different payments that the borrower can choose: a negative AM payment, negative amortization payment, an interest-only payment, a 30-year amortization, which would be your fixed conventional type thing, and a 15-year amortization. The lowest of which would be the negative amortization payment. So a lot of borrowers were taking the lowest payment they could get and using the negative amortization payment. And what happens is it increases the balance every month. So they're not even covering the interest on the loan. And when you get to a certain point, usually, what is it, 110%, something like that?
115 is what I was thinking.
115% of the original principal value, it triggers what's called a recast. And then they convert the loan, whatever the remaining portion of time is on that loan, they convert that then to a fully amortizing 30-year loan, and the payment skyrockets. So that's how a lot of the folks in California got these and got in trouble with it. It was not terribly popular here in Pennsylvania, but there were a lot of places in the country where there were problems with it. And I saw clients who came to me, before I was at National City, I was doing housing counseling, who people were trying to sell these to, and the sales guys didn't even understand what they were selling. And we had to talk a lot of people off the ledge from actually taking these because they were really a lousy product. An 80-20, oh, sure, go ahead.
Just about the option arm.
Yeah.
Is it always triggered by the percentage of the principal, or is it triggered by the value of the home?
It's not triggered by the value of the home. It can be triggered 2 ways. It can be triggered by the value of the principal increasing, or there's a set period of time within it that it will automatically recast.
Oh, okay, so some of them have like a set, like 5-year period.
Right.
Oh, okay.
Mhm. Right. I'm sorry, any other questions about that? Okay. An 80-20 is simply an 80% first mortgage with a 20% second mortgage used for a purchase. It's a way of giving up a homeowner 100% loan without them having to get title insurance. So on a regular mortgage, if you're going to take out more than 80% of the loan, the lender will ask for title insurance. By doing an 80-20, but taking the 20% as a second mortgage avoids having to get title insurance. FHA and VA loans can generally be either fixed or adjustable, so they're both. They're government-insured loans. All the FHA and VA do is they back the loan so that whoever it is that's investing in the loan, if the loan defaults, the FHA and the VA are picking up the slack on that. Different set of underwriting guidelines, a little bit more restrictive on the origination side, but not by much. And FHA loans default. Well, FHA loans were pretty much the original subprime loans. They've always had a higher default rate than conventional loans. Any questions about that at all? Mortgage types? Ma'am?
How come you don't put Fannie Mae and Freddie Mae under loan types?
They're not loan types. They're Fannie Mae and Freddie Mac are secondary market pooling agents, basically, who purchase mortgages, all types of mortgages, all these, and pool them for investors. And they were actually set up as a government agency to buy mortgages specifically to make sure that there was always mortgage capital available. So Fannie and Freddie are secondary market lenders. They provide guidelines for all of these types of loans, but they are not specific types of loans. Yeah.
I noticed you don't have USDA on there.
You're right. No, you're right. We don't see all that many of them. And yeah, I have seen a couple of. Yeah, the USDA is another government insuring type loan, and they have a whole different set of payment options and ways of dealing with defaults on them. So,
the term conventional, does that compare to FHA or VA insurance?
yes, conventional is a private Fannie Freddie type mortgage versus a VA and yeah.
So is it also, does it mean a loan that Fannie or Freddie would buy?
Yes.
So it also refers to the amount of the loan?
Yeah, it's kind of a flexible term. I mean, people refer to a conventional loan as any sort of conventional 30-year loan. Conventional in the technical term means that it's a Fannie Freddie type loan, but it gets used broadly. So. Any other questions?
The words conforming and non-conforming loans, what does that refer to?
A conforming loan would be a loan that conforms to Fannie or Freddie guidelines. And a non-conforming loan would be a subprime loan, something that doesn't conform with the Alt-A, subprime, something that's so exotic that Fannie and Freddie don't do it. would be non-conforming. Any other questions?
I heard of jumbo loans. What's the number that makes it a jumbo loan?
What is it, 750,000? Is that, I think it's 700. It used to be 400 and change, and they changed that specifically for the California market. Any other questions? Okay. This is just a sort of a list of basic documents. If you've ever looked through a mortgage package, you know what you'll get is about 75 pages of stuff. And really, there are only less than 10 that are actually true legal documents, or in that case, even relevant documents. The 1003 loan application is just that. It's the loan application. It's a Fannie Mae 1003 form. And it is the piece of paper that asks what your income is, what your debts are, what your name and address is, where you used to live, where you work, all that good stuff. It's sort of the basic information that the lender takes from the homeowner or from the borrower to make their underwriting decision. The 1008 underwriting summary, if you're ever doing a case and you're able to get one of these, it's fantastic. It is not a document that the borrower is typically given as part of their document package, but they are around. It's the 1008 underwriting summary, or the uniform underwriting summary. What this is the lender has a form that they plug all of the ratios into, the income, the value of the property, and it will spit back what all of the requirements are. And it's basically a roadmap of how the loan was underwritten. So if you want to look at a loan and you want to look at what the lender did versus what the borrower's actual circumstances are, this is the best piece of paper to have. You might have to fight for it. You're not going to see them very often because they very rarely will give them to the borrower by accident. But it's a terrific piece of paper to have if you can get it. The note is, sorry, Kathy, go ahead.
Would you be able to tell from that whether they were given a worse loan than they would have maybe qualified for?
Possibly, but that's going to be kind of a value judgment, because you're going to have to look at their credit and you're going to have to look at their actual income, and kind of by feel know whether or not, if they have an 800 credit score and they've got good income and somebody gave them a 9% loan, yeah, you could probably get that argument that they got a worse loan than they qualified for, that kind of thing. The note is the legal agreement between the borrower and the lender that they're going to repay. The mortgage is the legal notification to the county that there's a lien against the property for the loan. The good faith estimate is, there are two kind of primary numbers papers in here. There's a good faith estimate, the settlement, well, three, I guess, the settlement statement and the truth in lending statement. The good faith estimate is given to the borrower when they apply for the loan, and it is just that. It's an estimate of what the closing costs are going to be. It's an estimate of what is going to be required of the borrower in terms of their title insurance, their appraisal costs, any fees to the lender. And then along with that, at application, they're giving out the truth in lending statement, which is going to talk about the cost of the credit. And I'm actually going to let Dan talk. Dan, do you want to talk about the TIL real quick?
I would love to talk about the TIL.
Dan knows more about TIL than anybody else.
The TIL, truth in lending statement, what it does is it breaks down the true cost of the acquisition of the loan, okay? Because you have not just a principal value of a loan of $100,000, but you have points, fees, closing costs, broker vacation funds, whatever else they want to jam into this thing, right? So you have a note rate, we'll say 5% in a hypothetical, at the $100,000 that you're going to take out. However, you are going to have an additional cost of all those other fees that I just mentioned, which will cause the true interest rate of that loan, if you pay it on time, 360 months, of 6.5, something like that. Because what it does, it takes into consideration the additional fees that you're financing over the 360 months that you're paying that mortgage back, or that note back, okay? It also gives you the payment schedule of how you should be paying, not the dates, but if it's an adjustable rate and it adjusts after the first 2 years, it will give you 24 months of one payment, and then the additional term at the adjusted payment amount. So it's really the true cost of what this loan is going to cost the borrowers if they're on time with every single payment.
So that one will be different than the rate
that it would be at the note.
Well, because the note rate would, again, in my hypothetical comes out at 5, because that's the interest against the principal value. But it doesn't take into consideration the points and fees and other costs that the borrower is paying. As soon as you roll that into the financing, that true interest calculated against that will go up. And you see jumps from like 5.5 to 6, 6.5, 7 even, depending on how many points and fees are on that note, mortgage note. There's 4 actual disclosures. They give you the principal balance of the loan, the APR, which is the annual percentage rate, not the interest rate. You'll get what they call the amount financed, which is actually inaccurate. Don't ask me why they did it like that. They're bankers. And then the true cost of it. If you take out a $150,000 loan for 30 years at 5%, that borrower's paying back $300,000. So, and it shows that to borrowers. It was used as a device that borrowers were supposed to get while they're shopping for mortgages. I go to 4 or 5 different banks. I get preliminary truth in lending disclosures. I stack them in front of me at the kitchen table and find out what the best deal is.
So why is given at the end when we are signing the mortgage?
Right.
Not when they give you the deal?
No, you get a till with your initial 60-day disclosure. So you go in for application, you get a good faith estimate, you get a till that's an estimate, and then when you get to closing, you get a final till. You're supposed to use those estimated tills, again, in that comparison of, well, I went to 5 different banks, I got 5 different tills, let's see who the best deal is on paper right now. And that was the true purpose of it. Okay?
And then the one you get at closing is the one that actually refers to your transaction in particular and what your costs were there. And in conjunction with that, thank you, Dan. The good faith estimate, as I said, was the piece of paper that tells you what the estimate of all of your closing costs are going to be on your transaction. The settlement statement is the actual piece of paper that tells you what they are, who's getting money, who's getting disbursements, what fees you're actually paying. If it's a purchase of a property, it's going to show the disbursements to the seller and to the real estate agent if they're getting commission and all that stuff. And the appraisal we already talked about a little bit under collateral, but again, this is one of those documents that the borrower is supposed to be given when they close the loan. They have a right to get a copy of their appraisal. And you don't always get it, but you should. Any questions about the documents at all? I'm going to drop a pin on the floor. Go ahead. The settlement sheet is the actual listing out of, it's called a HUD-1 settlement statement. It's the listing out of what all the transaction costs were. So in a purchase transaction, it would list the selling price. It would list credits towards the borrower's purchase, which would include any down payment they put down, the mortgage loan. It would show any adjustments for taxes. So if the selling homeowner had already paid taxes, they're going to adjust prorated for the year. It would then show all of the costs associated with the loan itself. It would show the appraisal costs, the transfer taxes, the title insurance, and all of that stuff. So.
Would you consider, I'm sorry,
Sure.
that that's the most important document in the loan package?
From a disclosure point of view for the homeowner?
Yes.
No, I would say that and the truth in lending statement are probably the two most important ones, because the truth in lending is going to tell you what your true cost of your credit is.
If there are differences in the HUD.
Yes.
And the borrower has issues with those
Yes.
numbers, then that will affect all the rest of the documents or no? Like the mortgage and all, will all that be affected?
Potentially, I mean, your changes there would be if there's a change in a mortgage amount. Obviously, yeah, that's going to affect your note, what it says on your note or your mortgage, that kind of stuff. If it's an adjustment of something like taxes, for example, no, that's just a bottom line change. Yeah. Sir?
You said that the underwriting summary was going to be a fight to get. Can you speak to why there's a fight there? For example, if I wanted to discover one in litigation.
Most of the time, you're going to be dealing with someone other than the originating lender. And what will happen is that somebody originates the loan, they sell it off to a secondary market agency. That agency may or may not keep that document. By the time you get down to your third tier, Auckland or somebody like that, they've got the note and the mortgage, and that's it. So to go back and actually find your original set of documents for those loans becomes a struggle of going back through the chain if somebody actually has the paperwork somewhere. Yeah.
It has seemed to me that if you're in a foreclosure, you're defending the homeowner in a foreclosure, and you submit a discovery request for the entire loan origination file, that you do get that. It may take them some time.
Yeah, but you may have to go.
Have it, but they'll
It's,
go
yeah,
back.
it's generally not going to be the kind of thing that a borrower walks into your office and says,
Absolutely.
here's my discovery.
But in discovery, you
Yeah.
can.
So, any other questions? I feel bad if nobody asks any questions. Yeah, no, that's good. Okay, just to talk real quick about the who's involved with this stuff. A primary market participant. A primary market participant would be the people who actually interact with the homeowner, the borrower. The loan originator is your sales guy. He's the guy with the plaid suit and the really loud tie, who's out there explaining to your homeowner why they should take an option arm on a $30,000 house, and it's going to be fantastic and everything will be all right. That's probably the weakest link in the chain of mortgage lending, because that's the guy who's got the most at stake. Mortgage loans are generally written on commission, so that guy doesn't make a dime until that loan closes, so he has a lot of incentive to do things with that loan that may not be up and up. Mortgage broker, loan originators, by the way, can work for either mortgage brokers or mortgage lenders. A mortgage broker is an independent company that will provide loans that are available from other lenders. So a mortgage broker might deal with 3 different banks, and the idea is for the mortgage broker to be able to shop for the best deal for the borrower by going to 3 different institutions. Now, what in fact happened over the last couple of years is that mortgage brokers started shopping for the best deal for themselves and selling that to the homeowner if that was what they could get away with. I personally, if it's not, have a very low opinion of both mortgage loan originators and mortgage brokers. I think they're kind of parasitic on a transaction. There's no real reason, in my opinion, to use a mortgage broker other than the fact that they're going to take a big commission slug out of a transaction that they don't need to. John, you're late. The mortgage lender is the actual capital provider, typically. It can be a bank, it can be an independent mortgage company that has a line of credit that they're using as a warehouse line to fund mortgages. It can be a big company, it can be a small company. The mortgage lender in a transaction should have some sort of control over the underwriting of the loan, but again, they're relying on information that's being fed to them by the originator or the broker. And if there's a weak link in those first 2, that mortgage lender may not have accurate information and may make underwriting decisions that are flawed. The servicer is who the borrower makes the payment to. Maybe the mortgage lender, so if you take a mortgage from KeyBank and you make your payments to KeyBank is the servicer. It could be somebody totally different, so you may take your mortgage with ABC Loan Company and they may sell it to Bank of America, and you may make your payments to Bank of America. The servicer may or may not actually own the loan, so there may be a secondary market person in the background. But the servicer's real role is to collect payments from the homeowner, pass those on to the investor, make sure the taxes are paid, and do loss mitigation if the borrower defaults, which includes the foreclosure ticket money. Any questions about those? No? Okay. And then you get into the secondary market participants. And the servicer is here on both of them. The servicer, typically, some servicers own their own mortgages. Most loans are not owned by the servicer. Most loans are owned by Fannie Mae or Freddie Mac, for example, will contract with Bank of America or National City or whomever to collect their payments. It could be a private investment trust. It could be any number of things, but the servicer is collecting for those other people, the pool trustee. And they're governed by a thing called the Master Servicing Agreement, which is an agreement between the servicer and the pool trustee that will govern things like how often money has to be remitted to the pool trustee. It will enumerate things like how many loans in a pool can be modified if there's a serious default situation. it kind of tells the servicer what they can and can't do with any given mortgage, whether or not they're allowed to modify a loan on behalf of them if it's in default. And then that pool trustee in turn sells those shares in that pool to investors. And those investors typically fall into what are called tranches. And this is where it gets really screwed up from a mortgage lending point of view. And I put a website on here. I'm going to point this out. It's called thecrisisofcredit.com. And it's actually about a 10-minute video that sort of walks you through how all of these investors and tranches, and I'll try and explain it briefly, but I would encourage you to look at that website because it does do an excellent job of explaining it. And it's actually fairly humorous, and if you can imagine trying to make mortgage investments into something humorous, it's pretty good. What happens with tranches, there are typically 3 different tranches. There's a investment grade tranche, there's a B tranche, and a C tranche. And one of the reasons they're having so much trouble getting modifications is because those 3 tranches all have different interests in the, go ahead.
Can you explain what a tranche is?
Yeah, a tranche is just a division of the mortgage pool based on the quality of the assets and the payment. So a high grade tranche is going to have the lowest payment, but it's going to be the lowest payout, but it's going to be the safest investment. And a C, like a C tranche would be basically a junk bond, but it's going to have a higher payment. This is why I'm pointing you guys out to this crisis of credit video. But what happens is, in a foreclosure situation, what that translates to is that the high grade tranches get paid first, and the low grade tranches get paid at the end if there's any money left over. So what you wind up having is you might have one house and 3 people with 3 different interests in it. The high grade tranche is simply interested in having that house foreclosed on because they're going to get paid first, so they will be made whole. Whereas the C grade tranche, he gets paid last, so his interest is not in having the house foreclosed on, it's in sort of extending it, and you wind up getting into a conflict with the tranches. And what winds up happening is that they are going back to the pool trustee and saying, we don't want you to do this, and they conflict with each other, and as a result, nothing happens. So they wind up going through a foreclosure because they can't agree on what to do. But I do highly recommend this crisisofcredit.com as a piece to look at for that. And with that, I'm going to turn it over to Dan in a second. Does anybody have any questions about that?
I wanted to add to what you were saying, that the point of comparison to how mortgage payments are distributed these days, the old-fashioned model where one party had the right to your mortgage payment. You took a loan from your bank, you paid your bank, the bank was entitled to your money. At this point, there are many, many different investors who are entitled to the stream of payments from your loan and lots of other loans.
Right.
And that's why it's so much more complicated now
Right.
to try to get a deal on a mortgage that's not performing.
Or even talk to somebody who's
Right,
got the
because
authority to
there's-
do it, right?
The servicer just collects the payments and then distributes them to these different parties that are entitled to different pieces of the stream of payments.
Right.
And there aren't human beings anymore making the sort of simple economic decisions. Is it going to be worth more for me to take your payments than it is to take your house?
Right.
It's much more complicated. issue.
Right, and to that point, I mean, that's an excellent point. What you wind up having is sorry, man, I'm running long. Is yeah, you wind up with you may have a $50,000 house with a $100,000 loan. It would surely be in the lender's best interest to settle for $50,000 and take a principal reduction because it will cost them more to foreclose on that house than they're ever going to recover. But what winds up happening is that they can't agree on any of that, so they wind up taking the house anyway, and it costs them more money, and it's a bad business decision, but it's the only one that they can get tenably from the way the investor tranches are set up. Any other questions about that before I turn it over to Dan? Okay.
Yeah.
Let me go on.
Just a little example of it. My client got $37,000 in Social Security pay. So to pay off the mortgage would be $34,000. I offered $30, and they laughed at me. So we're gonna, I just complete it.
All right. Any other questions? Okay. And with that, I'll give you Mr. Sullivan. And Mr. Sullivan was at National City.
My dad here?
Our compliance manager, and is now a housing counselor, and is going to talk to you about that.
My wife says I can't use the remote. You're videotaping this, right? So video evidence. All right, guys. I'm a housing counselor. I guess you all heard that. And what I'm going to do is I'm going to go through the role of the housing counselors, what we're doing currently, because this has changed significantly in the last 7 years, and how hopefully you guys as legal services can use us and our expertise to help out your clients, okay? I'm going to say a couple things. One, I tend to go off the map a bit, so try to follow with me. Also, in terms of questions, just raise your hand, yell, throw a mint at me, whatever it takes to get my attention, because once I get started, it's like a really nasty housing counseling snowball. NFMC, the National Foreclosure Mitigation Counseling. This was created in about 2007. This was congressional money that was passed through the National Organization of Neighbor Works and then funneled out to HFAs like PHFA, some of the national housing counseling groups as intermediaries to fund what we have always been doing for years and years and years, which is loss mitigation counseling. Outside of what you see in HEMAP, there is other housing counseling that goes on, which is I'm going to pick up the phone, we're going to start working with the lenders, and try to get a deal done that's going to keep, you know, the loan solvent and borrowers in their house. Okay, what it has done is it's actually developed some level of standardization in the process. You know, counselors from California to New York all kind of did it a little bit differently depending on what their region was saying. This sort of set some best practices, and it does allow funding for this activity where there wasn't a whole lot of national funding for loss mitigation counseling. PHFA is an intermediary as long as the other intermediaries that operate nationwide to funnel these monies, but they come through Congress, to NeighborWorks, to the intermediaries, to the housing counseling agencies. Cool? Good. All right, foreclosure counseling. Guys, this is a completely different world than it was 10 years ago. Before, Greg and I were at National City, we both did housing counseling. What we did then is a lot different than kind of what we do now in terms of how we have to go about it, and that's not just with NFMC. The marketplace has changed significantly. We do bring clients in, perform a detailed review of the homeowner's budget, go over the income versus debt expenses, and what we do is we start forming those ratios that Greg talked about, those front-end housing debt ratios and back-end total debt ratios. We determine the viability of home ownership, which means income level versus debt obligation. You know, if someone comes in and 80% of their income now goes into their housing expenses, and it wasn't a fraud case, it was just a complete disaster with the income, they got laid off, medical issues, things of that nature, viability as a homeowner might not be available to them. And we have to be able to, as counselors, gear them into understanding that, you know, the money might not be here anymore. We develop an action plan, or how to work with your lender, what steps you need to take to work with your lender. We're picking up the phone and calling up a lender and saying, I need help, is about as effective as going into McDonald's, going up to the counter and saying, I need food. Well, okay, cool, you're at McDonald's, but what do you want? That's the key, is to get borrowers to understand what their rights are and what they can and cannot be asking for their mortgage company. HAMP has made that a lot simpler because it has sort of set a template for mortgage modifications, but it's not touching a lot of folks, okay? I think the lender that had the highest rating of HAMP loans in accordance to their mortgage foreclosure portfolio was Ocwen, and it was like 26% at the first report card level. So that's a quarter of the best loans in Ocwen, who's not a great lender. Can I say that here? I'm not bad-mouthing anybody. We haven't bad-mouthed before, right? That's a quarter of the loans that were in their portfolio they were getting serviced through HAMP, okay? B of A and Wells had 5 and 6 respectively, I think. So HAMP's not touching a lot of people that we're seeing right now. There are other loss mitigation modification programs in some of these larger lenders, and we try to train up borrowers to say, okay, listen, if you've been denied one, we got to find out why, what the details were, and let's see if there's another remedy available at the lender's level. And then provide guidance to homeowners. You know, guide them through the process. I'm there. Every single homeowner needs to give me a call and ask me questions. We'll walk them through it. I can be an advocate. I can help them with the phone calls and their discussions with the lender. Can't do it for them, but I can definitely provide as much guidance as possible. And we review affordability, and that's really key. When you look at the underwriting criteria, whether it be what FDIC proposed through Fannie and Freddie, what HAMP has done, what the lenders do with themselves, the key is going to be, from a housing counselor perspective and a modification perspective, income versus debt. It's as simple as that. I can do all the stories and letters of circumstance in the world, but nothing gets done unless there's money available in that game somewhere. You know,
If you take a look at HAMP, one of the guidelines is if you're on unemployment compensation, that is not considered income. There's a reason for that, you know? And that's really the push, is to get those ratios together and show back to the bank, listen, this is a viable asset here. There is income here. It might not have been what it was at one point. Yeah.
Sorry, what is HAMP?
HAMP is the Making Home Affordable, the government program through the Treasury Department, also known as Obama's plan.
Okay.
Right. Okay. I was going to print Obama money, like Monopoly money with his picture in the middle of it, but I couldn't do it. We determine equity position. One of the key leverage points from a housing counselor has always been if the house is underwater. You know, what's the LTV value now? One of the things we saw in Pennsylvania was not a huge dip in depreciation of property value because we never saw the big jam up that you saw in the sand states, the Californias, the Arizonas, Nevadas. So we don't have huge depreciation across the board in the Commonwealth, but going to like these predatory lending and subprime issues, you might find someone who was inaccurately appraised originally and come back and see a loan to value ratio of 150, 160%. That kind of give you some leverage in terms of working with a lender to get a deal done. And certainly in your cases, if you're going to litigate, you can come back and say, oh, listen, I have the old appraisal. We know property value did not fluctuate significantly in the last 5 years. How in the world did you take a $30,000 property and make it a $150,000 property? Push back to those guys. We can negotiate with the lenders. Here's where it's changed, and you guys already talked about this a little bit. Used to be I could go into, you know, Bailey's Savings and Loans and talk to George Bailey before Potter got involved and say, here's the deal. You foreclose on this thing, you take a $30,000 bath, there's an additional $10,000 to $15,000 worth of real estate charges, you're going to have to hire a management team, this is going to sit in your REO portfolio for a while. It doesn't make any sense to do this deal, right? And the servicer said, yeah, that makes sense to do. The distinction now with the secondary mortgage market and the servicer not being invested in whether or not that loan really comes to fruition has made it impossible to deal with servicers because, guys, if that loan goes to foreclosure and sells back on REO, you know who gets paid first? The servicer. They have no money in this game anymore. They don't care. We'll take it and we're still going to get paid. We're going to pay our attorneys, we're going to pay ourselves, and the loss is really taken to the investors, okay? So the borrower puts together the package, all reasonable, $30,000 property, $150,000 loan, income due to a layoff at the steel mill. Everything is valid and legitimate. They send over their letter of circumstance, their income, and everything else. It takes 60 days to underwrite the thing, and then they toss it to the trustees and the investors, and all that hard work is nothing because the investor's not seeing it like this anymore. There's enough tax code and enough that tranche that Greg was talking about and how, okay, well, we can cut the losses on some of the C-grade paper with A-grade paper still performing in this portfolio. We're not going to get a deal done anymore. So the idea of a real hard negotiation on a loan that is now in a mortgage-backed security, it's really difficult because you're not negotiating with anybody who's got any sort of vested interest in this property. You're not dealing with anybody who can do anything with this property. They have to pass it on down the line. So 10 years ago when I could call the local bank, talk to somebody, and maybe get a deal done based on some financial common sense, it's completely thrown out the window now. And I think that's why housing counselors are seeing less and less deals get done with a hard negotiation.
So what are you doing?
Praying a lot. I'll be honest, and I don't want to sound like I'm a pessimist here because I do think that if we keep pushing, but the wheels are off the bike, guys. It's going to be a lot of regulatory statute that's going to be passed. There's a lot of things in D.C. that need to be done so this doesn't happen again. And we just keep hammering and hammering. And I spend all day running into that brick wall. Sometimes the lenders listen. I mean, you do get some success stories out there. So it's definitely worth trying from a counselor perspective, and you try with everybody. But you're seeing less success stories because of the secondary market issues.
Can you speak to the servicer incentives under him? Is there anything there from the services?
Yeah, there is. They get a, I'm not 100% sure on all the data, but yeah, they're going to get a kick. They get a piece for every loan that they do a modification for. There's a flat fee for that. And keep in mind, it's a 3-month trial and then a 5-month full-term extension of that modification agreement, okay? And I'm going to touch on that because it's going to get dicey, guys, in about 2 or 3 months. The 5 years, every successful year that the borrower is paying 12 months on time of that modified payment, the servicer gets another kickback, okay? So they're getting something. Keep in mind, the real purpose of HAMP was to help capitalize banks on non-performing loans. That was TARP's intention in the first place, and it fell apart. So this is sort of like the second stab at, okay, well, banks have non-performing loans, and we're going to grease them a little bit and give them a little incentive here to actually do a modification. Keep in mind something. HAMP is very detailed in stating that remember that MSA, the Master Servicing Agreement on that portfolio? If your MSA does not allow modifications under the HAMP agreement, guess what, guys? They don't have to do the deal. And they're allowed out of the deal based on Treasury's decision. All right? One of the things that a lot of people don't know is the group that created this program, HAMP, and worked with the Treasury Department was a group of six of the major lending institutions in this country. Wells, Bank of America, Citi, all sat at the table with the Treasury Department and created HAMP. That's a lot of fox watching the hen house as far as I'm concerned. But that's it. The MSA doesn't allow the mod, you can't get the mod done then and then.
And it's just certain banks that had to get into the program?
Typically what we're seeing is anybody who received TARP funds were sort of pushed into it.
We are going to talk extensively about HAMP in the session, 2 sessions from now.
Correct.
So if we could put off questions about HAMP and let you try to get through.
I'm assuming you're the HAMP presenter then, right?
Only one.
It's a team. All right. So yeah, I just want to, but again, HAMP is what we're just to capture. It is what we're seeing as counselors as really the only sort of template for mortgage modifications, and that's the world that we're dealing in. Recommending exit strategy is actually becoming much more important for housing counselors now. Short sale, deed in lieu, flat liquidation of property, cash for keys, and I'll go over some of those in a little more detail. Are all exit strategies to get the borrower out of the house and in hopefully something that's a little more affordable for them. And I'm doing a lot more exit strategy counseling because we're seeing a lot of lenders come back with absolutely nothing. Okay? And then referring the client to other social services. How many folks here work for agencies that have direct referrals to housing counseling agencies in their area? Anybody? Direct referral, you pick up a phone, you call a housing counselor, you say, hey, I got a client, that's it? Is it because you don't have housing counselors, or is it because you don't know how this can work? Because it's effective, guys. When I've seen from attorneys who are able to litigate these things successfully and housing counselors being able to get better deals done, the connection between legal services and housing counseling is imperative. It's so key. Okay, we can't do the legal decisions for you, but we could definitely take a look at these loan products and say, hey, there's something wrong with this note. There's something wrong with this till. There's something wrong with the RESPA disclosures. Something's fishy here. You guys are going to have to push the legality of it, but something's not right. And that's part of the social service referral that we do. You look like you have a question.
Yeah, question, comment. You're speaking, I think, really knowledgeably about this. I also know that Action Housing is a non-profit agency. And can you speak a little bit about, the difference between the non-profits, which are really the high-quality housing counselors, and the profit?
My
Profit agencies.
personal opinion?
But also, what quality assurances are there for you guys?
Quality insurances?
Assurance that, if we refer people,
How do you know that they're...
you guys are good?
I say I'm good. All right. No, and I think that's one of the things you're going to run into is that there's a lot of housing counselors out there that don't have banking backgrounds. And what you've seen, again, is old housing counselors, you just pick up the phone, we're going to beat up the lender, we're going to get something done. Now, because of the secondary market, you do need to emphasize housing counselors with banking backgrounds so they understand what the rules are to get something done. I don't know. You're going to have to start working with your local agencies and get a feel for that individual housing counselor. PHFA does have recommended housing counselors both in loss mitigation and directly through their NFMC contract, okay? I will state that not every quality organization is receiving money directly through PHFA. We're one of them right now. So, go by not just the PFA recommendation, but other organizations that are working in your area. NFMC and lenders counseling agencies receiving NFMC monies do have certain requirements they have to meet. It did set, like I said, a precedence and a template for what you need to be doing as a housing counselor. So it's not just kind of, I'm going to throw it up against the wall and see what sticks.
I think what Don's experience might be what I'm experiencing, or hearing about, is that I work really closely with the housing counselors in my county, but they
Okay.
for the person who's sending them off with it.
Okay, now, here's the question now. What's the interpretation of what they should be doing from your perspective? And, because here's the problem that you get, again, with this secondary market thing, is that once you get a deal on the table and say it is HAMP, there's nothing else out there, because you've lost the ability to negotiate because you're not calling anybody who's vested in that product anymore. So that old idea of, well, I'm going to send them off to a housing counselor and they're going to beat them up until they get a good deal isn't there as much anymore, because you have this issue of, well, I'm going to give you HAMP, Wells Fargo, I'm going to give you HAMP, and that's it. And if you don't like it, fine, I'm going to take you to foreclosure because I got hundreds of thousands of other loans in foreclosure right
My
now.
housing counselors aren't getting a deal on the table, they're just.
Oh, you're going to interrupt me?
Yeah, I mean, I think to answer your question this way, people like Dan and I have kind of a unique background for housing counseling in that we've been lenders, so we have a very deep understanding of the process. Not every housing counseling agency does. So you really just have to do some investigation as to what their backgrounds are and what they know and what they don't know. We have seen people try to hire people out of lenders, and it's a good idea because those people do know what it is, but you have to do a little research on it.
You haven't mentioned email either. Email. I don't think that's it.
What would you like me to state about HEMAT?
We love it. Talk about it.
Let's talk about HEMAT?
We're going to talk about that later, too.
Okay. Well, then just mention.
It's basically like a bridge loan program. Most of the counseling agencies in your area will perform HEMAP counseling, but keep in mind that HEMAP counseling kind of and sort of stops at the time that the application goes out. So there's HEMAP counseling, take application, send it out to Harrisburg, and then there's loss mitigation counseling, which is the more in-depth of, I gotta dig it. And Greg's right, guys. I mean, you gotta know your area and what housing counseling agencies are effective in your area. Do the research, do the outreach, and see what happens. But don't get your hopes up to thinking that a housing counselor can just pick up a phone and all of a sudden a magic deal appears because of the way the market's structured now. I will try to wrap up because I got the warning. All right, negotiated outcomes. Modification, we all know what they are, right? Yes. Okay, recapitalization, taking the arrears that's still owed on the mortgage and sticking it to the back end. Keep in mind that causes an increase in principal balance. If there's not an interest rate concession given also, the payment's going to go up. Forbearance, which is typically what we're seeing, 3 or 4 months worth of forgiveness of a payment. Keep in mind that that missed payment gets recapitalized back into the mortgage, but it gives them some breathing room, especially if you have a short-term layoff situation or seasonal employees. Folks who work for universities and the school districts and things of that nature, it can work. Deed in lieu of foreclosure, short sale, those are two of the exit strategies that we'd work most on. Deed in lieu is basically you're signing the deed over to the lending institution. Okay, they're taking it over in lieu of the actual foreclosure. We have seen a lot of success with these in terms of borrowers who just, I'm done with the house, I can't afford it anymore, the kids are gone, usually older couples, and they're just signing the house over and moving on to something else. Short sale, that means selling the house for less than what you owe on the property. You owe 150 on it, but you can get 100. The bank will agree to selling it. It's a misconception that either the deed in lieu or the short sale have less of an impact on the credit report. They both will crush your credit report just like the regular foreclosure. Okay? Of course, there's foreclosure, and then, of course, the borrowers can reinstate the loan and bring it current. Conciliation process, real quick. This uses the power of the bench, just like the Jedi mind trick, to encourage lenders to make reasonable settlement, and it provides additional time for homeowners. What happens is, let me go real quick, homeowner receives the judgment, the notice of complaint and foreclosure, not the judgment, the complaint and foreclosure notice. In Allegheny County, they stuck a hot pink letter on top of it with an 866 number that goes to the county offices. Borrower has 20 days, just like they have in terms of responding to the complaint, 20 days to call up Allegheny County and get into a mortgage conciliation process in which they have to meet with a housing counseling agency. They're assigned an MG number instead of a GD number as long as it's owner-occupied residential property. This does not apply to commercial property, rental property, or anything else that's not owner-occupied. Counseling agency goes in and performs their normal NFMC counseling, tries out the resolution. What we're seeing is that if no resolution is resolved, you're looking at like 60, 90, 120 days in some cases, depending on how quick the judge is to turn these things over. They're usually about 90 days. Everyone comes in front of the judge. We all go sit in his chambers. You have plaintiff counsel on one end, defendant, and whoever defendant wants as a representative, whether it be their housing counselor or legal services or whoever. The judge hears the arguments on both sides. Here's the problem. All the judge can do is use his judicial persuasion, if you will, to try to entice the lender into getting a deal done. He can stay the foreclosure, but we have not seen any precedents either here or in Philadelphia where a judge has forced a lender to deal a deal outside of what their servicing agreement would allow. If anybody who practices in Philadelphia at the conciliations has seen something contrary to this, please tell me, because this is a point of contention in Allegheny County right now, that the judge doesn't have any authority to sort of like do away with the contract. Again, he can make suggestions, delay foreclosures, but cannot impose settlement at this time. This is the value for attorneys. We provide consistent, standardized homeowner triage and loan analysis. It's key for housing counselors to be able to say, okay, listen, I got a legal issue here. I can't handle this because I'm not an attorney, but I know who I can send them to, and vice versa. When you guys get people in your door and you see something that might be rectified through a modification or loss mitigation technique, you can refer them back to the housing counseling agency. Counselor will typically have an engaged lender and can provide feedback. I got a lot of cases, Kathy, with your group right now like this, where I'm doing phone calls. I wake up every morning, I call the borrower, I call the lender, and then I call her office. All right? And then counselors can identify predatory characteristics. Now, keep in mind, there's a difference between the legality and the knowledge that the counselor has about what the laws state. Not every housing counselor knows about TILA and RESPA. All right? But they can say, hey, look, this looks funny. It looks like a duck and quacks like a duck. It's a duck. All right, and that's our contact information, and I got business cards and all that jazz. Is that, are we, whoa, 3 minutes, huh? Not bad. Anybody, if you have any questions, because Kathy's booting me out, please see me. I'll be lingering, but I'm going to take off the tie, and we can go over whatever the heck you want to go over, okay? Done. Thanks, guys.